Hey guys, this is Tony from alphapursuits.com. In this video, I want to share with you some of the earning trades that I did recently. And what's so special about this bunch of trades that I did was that instead of using 45 days to expiration, like many other websites talk about, apparently that's the optimum expiration, time to expiration options to use. I actually decided to use a much longer duration options. So as you can see on the screen here for this particular one, I traded December expiration, and right now it's July. And let me switch the graph very quickly here to show you when the earning is coming out, which is on August 3rd. So as you can see, I am doing something quite different from what other websites preach. And the reason for that is I've done some, not too many, it's just a few sort of longer duration options trade, and it went pretty well. So I thought, do an experiment on the earning trade to see, exactly how well this kind of trades can be. So as you can see for this particular one, AAOI, I placed it on July 6th. And at the time, it was already 100% implied volatility. And since then, it has moved up a lot. And basically, in both price-wise, price range, and also implied volatility move against me. So I'm in a little bit of trouble for this particular one. As far as we can see, the in the out of the money probability is pretty high now on the up end, because right now it's trading at 102. Well, actually, it's trading at about 100. So I'm in a big trouble right now. Minus about 3,000 on paper. But what I'm hoping is that obviously when the volatility drops, so let me show you this right now. Since I placed it when the implied volatility was only 60%, and again, at the time it was already 100, and I thought it wouldn't go up anymore, but it just kept going up. So even if the implied volatility comes down a little bit, it doesn't really help too much. But of course, it does help, as you can see on the graph here. So let's take a look. Right now it's at about 95%, about 1.08. So I'm hoping that you will come back down to sort of a normal level, so 0.8-ish. So it's 110. So let's do 0.08, see what it's gonna look like. Let's do 15%. So which will be around sort of that orange. So if it goes down to orange, and then if the price goes down to about 87, 88, then I could break even at that point. Or if it goes down a little bit more back to the original level where the trade was placed, then it will be very good for me. But as of now, it's around 100 right now. So even if the implied volatility drops down, unless the price actually moves back quite substantially, I will be in a big trouble. Now, obviously, I didn't plan to hang on until December. My thinking was, as soon as the implied volatility drops, then I'm gonna get out. So for this particular trade, since it moved a lot in price and also the implied volatility, I'm in a bit of trouble here. Let's move on to the next one and see if the other one will be much kinder to me. So ATVI, which is another one that I traded recently. Let's take a look at when I actually traded. So this was July 10th. And since then, the implied volatility is going up and down, more or less the same level. And I got in at around 57, 58. So when we come back here to the other graph, if it stays around 57, 58, then it would be very good when the implied volatility drops. As you can see, right, if it drops, it doesn't normally drop that much for this particular stock. So Let me decrease that a little bit. It's more realistic this way. So let me drag this here. Right now it's at 0.37. So when it goes down to say 0.30, okay, 0.32 even, then it's gonna go to positive area. As you can see, $258 if it's $58. And right now it's at 62. So even if it stays around 62, if the implied volatility drops, you will still be positive of $100. So you can see how powerful it is with regards to this kind of earning trades, because the implied volatility is very high. When it drops, you can recoup. You can actually make a quite good living, earning there. But obviously, when you start trading way before the earning date, the price could move quite substantially. As you can see right here, it did move quite a bit since the day that I traded, went all the way up. So one of the reasons why I traded long duration is, if you look at the actual sort of delta, I like to trade delta around 15 on each side, so 30% losing, 70% winning, that kind of ratio. For this particular case, since it moved quite a bit, this is a little bit off now. As you can see, 0.34, so it's 34% losing on one side and only 9% losing probably on the other side. But at the time when I traded, it was about even on both sides. And so if you go out in time, you can see, the price range will be much bigger. In fact, let me show you. Say if we do September, I'm just gonna assume there's enough volume. This particular it doesn't, but just looking at the delta, 15 minus 15, 16 delta will be 55, plus 15 delta will be about 80. So you can see the price range is much narrower as I have 45 and 70 set up. So it gives a much wider price range for me to play around with. So in case if it moves against me, I can just sit there and wait a little bit for it to come back. So not only that, I traded earlier, way before the earning date. So I also recoup. I also earn some of the time value there. So I'm earning the time value. I'm also have a big wider range that give me more time to wait for the price to move back into the direction I'm hoping, or the price range that I'm hoping you would stay. And then there's the implied volatility, which I'm gonna be able to earn some credits there as well. So you can see that those are the rationale why I'm thinking of, I'm experimenting this sort of using a longer duration options rather than the shorter duration, because with the shorter duration, when you set up 15 delta trades, the price range is much smaller compared to the longer duration. So I'm giving myself a lot more time to play around with, and a lot more credits as well to play around with. And obviously active management is the key. So when the implied volatility drops, and then when I see, even if it doesn't hit the target of the exit point, I probably just gonna get out at that point if it's positive, or a little bit negative, even if it's a little bit against where I want it, against my price range. The reason being, after that implied volatility drop, there isn't really any other advantage for us to hold on to it. So let's see what will happen. Now I want to go through a couple more here. CAR, again, this one went against me as well. I placed it two separate strangle trades here, and as you can see at the time, the implied volatility was already pretty high, and it actually went even higher. So when you look at the other graph here, risk profile, let's come back here to expiration. So unless the price comes back down, I'm actually in a bit of trouble. I actually have a shorter duration, August expiration, options. So this one is, it's right now it's like 32, 33, 33. So it's way beyond the price range that I'm hoping you would end up with. But obviously there's still about 30 days to expiration. So I'm hoping that you will come back down. And with the implied volatility drop, it should give me a pretty good chance of winning. So I'm not giving up on this one yet, obviously, and we'll see what happens. And let's do one more. So this one as well. Right now, it's sort of within my price range, 1166, and I placed it at this level here. So the implied volatility went up and then came back down to more or less the same level. So I'm just waiting for really the earning, which is basically next week, and so you will, the implied volatility will basically drop, and so that I can benefit from it. So that's basically what I'm doing right now, and I just want to share this quickly with you. And if you have any questions or want to find out more about why exactly I chose to do the longer duration, I do have some data to back it up as well. So thank you for watching, and if you have any questions or comments, please leave in the comment section below of the video. Thank you.